Hi, this is Brenna Surratt, Wealth Advisor at Bernie Wealth Management, and today I'm joined by Bijal Patel, a partner and senior wealth advisor on the team. Welcome to another episode of Byte Size Retirement, where we take common retirement planning topics and break them down into bite-sized pieces. These videos are not tax or investment advice, but hopefully set a foundation to build off of. And while we're taking just a few minutes to explain these topics, please take more than just 5 minutes to make any of these important financial decisions. So with that, today's topic is everybody's favorite, taxes. More specifically, mid-year tax planning. At the time we're recording this, it's July, so a great time to really sit down, check in on your taxes. So with that, Bijal, I'll pass it off to you. Do you want to, kick us off with step number one when it comes to mid-year tax planning?
Yeah, that's great. For many of us, unless we filed for an extension, we're finally done with last year's tax return. But after taking a short break, it really is a great time to start thinking about how you can make changes today that will impact this year's tax return itself. The first step to do is really take a look at last year's tax return. And for many people, that is a binder of pages or online forms to take a look at. But in breaking it down as a first step, I would say look at three things that really will have an impact on your tax return itself. One is, what's your marginal tax rate? And people will ask, what exactly is that? This is the rate that is charged to a taxpayer on the last dollar of income that they had. So the next dollar that you make, what rate will you be taxed at? So someone who's in the 37% tax bracket, if their income is higher this year, they can count on for every extra dollar that they make, they'll be paying an extra 37 cents in taxes themselves. So kind of understanding where you fell last year in terms of your marginal tax rate will be a good starting point to identify what your tax liability is going to look like for this year. The second thing that we find that impacts someone's tax return is capital gains. And capital profits from capital gains are the sale of an investment, such as stocks or real estate, that are subject to capital gains taxes. How much these are taxed at depends on how long you've held the investment itself. If you held it for less than 1 year, you're going to be charged your ordinary income bracket. If you held it for more than 1 year, there are different brackets that apply to taxpayers. And this bracket can range anywhere from 0 all the way up to 20%. So it's important to keep in mind, where you fall in this category, and if you're going to be making additional sale of investments, how it's going to be taxed for this particular year itself. The third thing is, and this is the one that people take a look at, they're looking for ways to reduce their taxable income. So the question comes up, should I take the standardized deduction or the itemized deduction? And the difference between the standard deduction and itemized deduction comes down to simple math. The standard deduction allows income to be lowered by a fixed dollar amount, depending on your filing status. On the other hand, you can itemize deductions are made up of a list of eligible expenses, which can lower your overall return. And you're allowed to take the higher of the two when it comes to deductions on your tax return itself. So these are three things that are really important to take a look at from last year. I'm going to hand it over to Brenda to say what are a couple of things to look at from now to the end of the year to really optimize this year's tax return.
Mhm. Definitely, yeah. And Bijal, like you mentioned, it's really important to sort of check in, review last year's tax return, and kind of look backwards. But then step number two is looking forward and looking at those mid-year tax projections. So really sitting down with your financial advisor and talking through any changes in your income that could, play a role as an important tipping point for knowing when to take certain actions that could really improve your future tax situation. Some common examples are Roth conversions, or if it's your first year taking a required minimum distribution. Both of those could have significant impacts on your tax situation potentially. So kind of just reviewing those, mapping it out so you have no surprises. Another great sort of checkpoint is just reviewing your withholdings at this point in the year, and then making any tweaks or adjustments for the rest of the year to make sure you're setting yourself up for success. And of course, a lot of these topics we could talk about for days and days probably, but we're trying to keep it bite-sized for this video. So We do have separate videos covering Roth conversions and required minimum distribution. So we'll link them below if you want to check those out in more detail. But also leave a comment below letting us know if there's any topic that we talked about in this video that you want us to dive in a little more detail, or just any retirement planning topic in general. But I think the real key takeaways here in terms of mid-year tax planning is, step number one is checking in, looking backwards, reviewing that tax return. Step number two, looking forwards, reviewing any changes that may impact your situation. And, really viewing tax planning as a year-round sport rather than just kind of blocking it out until tax season comes around. And I think you'll be pleasantly surprised if you take the extra time throughout the year to really optimize your situation. So with that, thank you so much for tuning in. And again, leave comments below if you have any other retirement planning topics you want us to cover in more detail. Thanks.